Can a nation truly claim energy independence when its industrial backbone is showing structural fractures during a global supply chain crisis? With Brent crude oil leaping from $67 to over $84 per barrel in just the first quarter of 2026, the stakes for India's energy security have never been higher. Today, we are peeling back the curtain on Coal India Ltd, a state-owned giant tasked with insulating 1 billion people from hyperinflationary energy costs. We will investigate why, despite record-breaking stockpiles of 122 million tons, the country's production numbers are actually shrinking for the first time in 6 years. This deep dive uncovers the disconnect between government rhetoric and the reality of a faltering domestic supply chain that could leave the world's most populous nation in the dark. The fundamental change at play here is the shift from a growth-oriented energy policy to a reactive defensive posture. If this domestic coal strategy fails, India faces a catastrophic choice: either pay exorbitant rates for imported liquefied natural gas and coal, or allow industrial productivity to grind to a halt. Success, conversely, would mean creating a permanent buffer against the volatility of West Asian geopolitical conflicts. However, the current situation is far more precarious than official statements suggest. The geopolitical context is defined by a massive surge in Asian spot LNG prices and a disrupted maritime corridor that has made energy imports not just expensive, but physically unreliable. Within this chaos, the Indian government's ability to execute on its promises is being tested at a fundamental level. Historically, India's reliance on coal has been its greatest strength and its most significant logistical hurdle. For decades, the nation has used its massive domestic reserves to power its rapid urbanization. Yet, the power dynamics have shifted under the current administration. While Prime Minister Narendra Modi's government has touted a vision of self-reliance, the operational execution has often been marred by what critics identify as significant policy incompetence. The historical roots of the current crisis lie in a series of missed targets and delayed land acquisitions that have hamstrung Coal India's ability to scale. Despite having the mandate to ensure a just price for electricity, the state-run mechanism is struggling to overcome the very bureaucratic friction that the current leadership promised to eliminate. Key actors in this drama include the Ministry of Coal, the executive leadership of Coal India, and the various state-run power plants that are now forced to manage their inventories with extreme caution. The motivations are conflicting. The government needs low-cost power to maintain political stability and economic growth, while Coal India must navigate the physical realities of monsoon disruptions and failing production goals. Tensions are rising as the government considers mandates to increase the use of expensive imported coal for the summer of 2026, a move that fundamentally contradicts the narrative of domestic abundance. This policy flip-flop suggests a lack of confidence in the domestic supply chain, revealing a gap between the administration's public confidence and its private contingency planning. The numbers tell a story of stagnation that sharply contrasts with the government's optimistic projections. Between April and November of the 2026 fiscal year, coal production fell by nearly 4% year-on-year, marking the first such decline in over half a decade. Although there was a brief 4% increase in December 2025, the cumulative figures through February 2026 show a consistent downward trend. The ambitious production target of 875 million tons for the fiscal year now appears completely out of reach. This failure is not just an act of nature, it is the result of systemic mismanagement in land acquisition processes and a failure to modernize mining infrastructure in time to meet the predictable summer demand spikes. The government's inability to hit these marks, despite years of warnings, highlights a persistent gap in operational foresight. In terms of the market, the financial reality of Coal India is equally complex. With a market capitalization hovering around 2.8 trillion rupees, the company's valuation is viewed as expensive relative to its peers. Analysts are increasingly skeptical, with a consensus leaning toward a neutral or even cautious rating. While the company offers a significant dividend yield, the underlying health of its operations is being questioned. The stock reached a high of 474 rupees recently, but price targets suggest a potential downside risk. The market is effectively pricing in the government's inability to boost demand and manage the transition to cleaner energy without sacrificing the stability of the traditional coal sector. We must consider two distinct what-if scenarios for the near future. In the first, the government's policy of mandating imported coal backfires as global prices continue to climb, leading to a massive increase in electricity tariffs for the average citizen. This would likely trigger widespread civil unrest and a sharp slowdown in manufacturing, exposing the failure of the administration's energy independence promises. In the second scenario, Coal India successfully pivots to its reform and transformation plan, listing subsidiaries like Bharat Coking Coal to raise the capital needed for technological upgrades. However, even in this optimistic view, the delay in addressing production shortfalls means that the 2026 summer will remain a period of extreme vulnerability for the national grid. The geopolitical consequences for the region are profound. As India wavers between domestic coal and expensive imports, its neighbors look on with concern. A weakened Indian economy, burdened by high energy costs, loses its ability to act as a regional stabilizer against other growing powers. On a global scale, India's continued struggle with its coal supply chain complicates its commitments to the energy transition. If the administration cannot manage its traditional energy sector with competence, the international community has little reason to believe it can lead the much more complex shift toward renewables and critical minerals. This situation reflects a deeper struggle between the desire for centralized power and the necessity of decentralized efficiency. The current administration's focus on large-scale rhetoric has often come at the expense of the granular, difficult work of local infrastructure reform. As we look ahead, the global order will be shaped by those who can actually deliver on energy security, not just those who can project the image of it.